Morning, everybody, and welcome to our webinar on reward and incentives update. You will see as we go through, there have been a fair number of developments to talk about, lots of things to think about in terms of the impact of changes in the wider economic climate and how they flow through into rewards and incentives. I think on that theme, what I would like to do would be to just give an overview on where we're going to be focusing our attention. As you can see from the slide in front of you, I'm going to spend a few seconds talking about the general direction of travel as we see things, talking to our clients and seeing how they're acting with their various incentive plans. We're going to spend some time looking at the outcome of recent case law, corporate governance developments, other developments, and then winding up in a summary. My name's Stephen Woodhouse. I'm joined this morning by my colleague Charlotte Fleck,
Hi everyone,
who will be helping as we go through. So first, general direction of travel. I think that we've all seen over the last 10 years or so, really, in my view, starting with the financial crisis in 2008, possibly with some follow through from previous concerns, an immense degree of focus on reward and incentives, whether they're effective, whether they're excessive. We will come across a couple of cases which have been in the news recently, which have reignited that debate. And we look at it from the point of view of helping to design plans and try to think ahead to make sure that the plans that are put in place, so far as we can, anticipate changes. It's not possible to anticipate all the changes that can come through, but thinking about the way that the plans operate in the commercial context, we believe is the right way to try to achieve that. So we thought we'd start with looking at a couple of recent cases, because one of them in particular flows through directly from the issues with the financial crisis, which is the judgment in relation to the Lloyds Bank case. So for those of you who don't remember, this concerned the circumstances arising at the time of the crisis, and the Daniels referred to there is Eric Daniels, who was the chief executive at Lloyds Bank at the time. And the background to the case, or the context to the case, was that HBOS was one of those banks which suddenly, at least in terms of public perception, and I think government perception as well, found itself to be insolvent. And this was at the same time as Northern Rock had just collapsed, that RBS had in effect collapsed and was being bought out by the government. And there were real concerns that this was happening not just in the UK, but globally, that the world financial system was collapsing. And I think it's relevant to look at that context, because what happened at the time was that Lloyds Bank, headed by Eric Daniels, agreed to purchase HBOS. I think there's a degree of speculation as to what was happening behind the scenes, but I think it's fairly clear that Lloyds Bank and Daniels were encouraged to enter into the transaction, and probably that may not have been for purely commercial purposes as far as Lloyds were concerned, but part of the overall economic context. The problem with the transaction was that having bought one insolvent bank, that, and I'm no doubt oversimplifying, but in essence meant that Lloyds itself became insolvent because it couldn't cope with the impact of HBOS on its balance sheet and its costs, which in turn resulted in the government stepping in and acquiring a substantial stake in Lloyds. In that context, the senior executives at Lloyds had awards which were meant to be which were vesting, and they took a fair amount of flack from shareholders, whose essential argument was that they ought to have carried out more due diligence, they ought to have been exercised more care, and that the consequence of the takeover, putting the strain on Lloyds that it did, was adverse for Lloyds shareholders, which I no doubt is a correct statement. But what's happened in the case is that the court, the shareholder groups then sought to withhold bonus payments from the executives, which were in terms of their terms, duly vested. And the court decided, the High Court decided, that they were going to issue summary judgment in favour of the executives. Now, we don't know whether this will be appealed. Maybe it will. I don't know. But what that means is that the court were coming to the conclusion that there was no real prospect of success in the case. Now, I think that that is interesting from the point of view of the interpretation of plan rules and plan documentation. And many of the practical implications that we've added to the slide there are to some extent obvious. But I think that it's relevant to read through the case and just see how that's applied in practice, and that it will be applying principles which really are in some ways obvious, and which are relevant to all share schemes. So if you have a share scheme which is an agreement between the company and the participant, it's not possible, unless it's provided for by the plan rules, for the employer or anybody else simply to decide that the rules ought to be amended because that's a nice thing to do or the right thing to do, without being justified by the plan documentation. That extends to the vesting of awards, and also one of the points coming through from the case relates to the exercise of discretion. And this is not just the Lloyds Bank case, because there have been other cases that have been coming through the courts recently, probably driven by similar pressures, where discretion has been sought to be exercised by remuneration committees, taking into account the wider context of shareholder pressure, concerns about quote-unquote fat cat pay. And the point there is that if you have discretion in a plan, it needs to be operated properly in accordance with the plan terms. It's not good enough simply to say, well, we've got discretion so we can do what we want to do. There needs to be proper thought given, and the discretion needs to be exercised reasonably and carefully, and unless it's very clear that the discretion is absolute, which will be an unusual position to be in and not one which courts will tend to support. So similarly with that, if there are widely drafted exclusion clauses, they will tend to be interpreted so far as you can when it's a widely drafted clause, narrowly, in order to get to a position where the courts believe that the interpretation of the documentation and the plan is consistent with the basis on which the documentation was entered into. And I think reading the Lloyds Bank case in the context of the background at the time is quite educational. So another area which Charlotte's going to talk about from another case is age discrimination.
Yep, this is a very recent case, Air Products PLC and Mr. Cockram, who, if you read through the case, sounds, as is so often in these cases, to have been a bit of a difficult character. But what this case does flag up is something that I've often found myself worrying a bit about when drafting plans, which is the operation of good leaver retirement provisions. That Mr. Cockram's case was effectively, his plan rules said that if someone retired on or after the customary retirement age for their location, in this case that was the UK, they would be allowed to keep their share awards as a good leaver. If they retired any earlier than that, so in this case, the customary retirement age in the UK was 55, so if they retired just before their 55th birthday, they would not be able to keep their share awards. And it's, in some ways, it's hard to see the justification for that, saying if you're a year older or a year younger, you'll be treated very differently. Well, yes, that does sound like age discrimination, and that's the point I worry about. And the case, to be clear, did find this was age discrimination. You're treating people of different ages differently. Of course, that's discrimination. But it was objectively justifiable as a proportionate means of achieving a legitimate aim. What does that mean? Well, if you're an employer company, you put in an LTIP to try and incentivize people to stay with you and to achieve results over the long term. So saying you're getting this in exchange for your work for us over several years, but not if you retire early. In that case, that's fine. You can just take your awards and go. On the face of things, I can see how that seems a bit odd. And that was effectively Mr. Cockram's argument. The other part of his argument was that he was a beneficiary of a defined benefit pension scheme, under which he was allowed to retire and take his pension at age 50. And so he argued that that ought to be treated as the customary retirement age for him, because that was the age under which he could take his pension. So what did the court say? Well, it might seem a bit odd to say that someone who retires should be treated very differently from someone who leaves the company a year earlier than is customary. But you've got to balance two objectives here. One of them is providing long-term incentives to your employees, but the other is not providing a disincentive to people to retire early. And I can quite see how, if you say, well, this person's 54, so under the terms of our pension scheme, they can retire in a year, so we're not going to give them an LTIP, that would be very, very hard to justify. But equally, you don't want to say this person's 54, we're giving them an LTIP, and that now means we're going to try and make sure they don't retire for several years. Also a little difficult to justify. There are lots of reasons why companies, it is generally allowable to say that people who retire at a particular age will be treated differently. For example, you don't want to say that employees aren't allowed to ever retire, partly because eventually people will, for health reasons, need to stop working, and partly because you want to make space in your organisation for younger employees coming up from below. The other point there is that Mr. Cockram was part of a defined benefit pension scheme. He could retire at 50. That was no longer open to new employees, as you might expect. And so the court said, well, it's not really fair on younger employees if they get treated worse under the plan than older employees, just because that older employee was part of a pension scheme that's now closed. And speaking as someone rather under 50, I have to say the argument that you should be allowed to retire and take a full pension and take all your share awards as a good leaver at age 50 does seem a bit of does seem rather difficult to justify these days, in particular where it is very rare for someone to have to be able to end their working life and retire on a good pension at age 50. Most people, frankly, at age 50 wouldn't want to retire these days. You can expect to be in good health, and you can expect that you will be in a position to keep working. So I'll hand back to Stephen now to talk a bit more broadly about corporate governance developments, having focused on those two particular recent cases.
Thank you, Charlotte. And I think both the cases do highlight important points and the need to think quite carefully about the interpretation and design of plan, not just in isolation, but in the context of wider developments, both with the operation of incentive plans and wider societal questions and issues. And this flows through into looking at the corporate governance developments. So in November 2016, the Department for Business, Energy and Industrial Strategy, BIS, published its Corporate Governance Reform Green Paper, two snazzy titles in one sentence. The paper, I think, is significant. I think there'll be an element of waiting to see how significant over time, depends on how people respond to it, whether they take on board its recommendations. But a lot that was said in there is, in my view, quite straightforwardly common sense and a sensible way to approach matters, even though it is commenting and recommending changes to existing practice. One point I was not so sure about is that there is a statement in bold in the paper to the effect that companies should look at not using LTIPs and instead should establish deferred stock plans. And it wasn't entirely clear to me what was actually meant by that, and having discussed the recommendation in a number of remuneration committee meetings, most remuneration committee members are not clear either. So I think that was an example where there was a bit of lack of clarity with what was meant by the statement. But if you read some of the other recommendations, I think, again, to use the same phrase I referred to earlier, you can see the direction of travel. So the recommendation in essence is for a simpler LTIP structure based on salary and long-term equity. We'll come on later to talk about one or two wider concerns, but in this context, having plans which are which operate by reference to complex performance conditions, which very few people really properly understand, is seen as a weakness, and is seen as something which impinges on the ability to achieve meaningful incentives, and means that the plans are actually less effective than keeping something clear and simple which everybody understands. Of course, that is easier to say than to do when you're operating in a complex environment, particularly if the company is in the financial sector and subject to constraints from wider European regulation and the concerns about the operation of the banking system. But as a principle, trying to maintain simplicity and transparency, and also the point there about looking for long-term equity, is one to be applauded. And looking at the question of what is long-term, for many years, long-term has been taken to mean 3 years. And plans have traditionally been designed with 3-year vesting periods, maybe a rolling program. And what the report was suggesting, which I think is being seen in practice, is that award should have a longer vesting period. Long-term should mean genuinely long-term rather than arguably medium-term. And clearly these are terms where you can argue what it means in different contexts. But the direction of travel, again, is for awards maybe to have a 5-year period without large steps along the way, to have a limited use of short-term performance-related cash bonuses. This is going to the desire to ensure that awards outside salary reflect genuine shareholder value. And to some extent, when I'm talking about this, I find myself using phrases which have been used for a long time and maybe perhaps haven't been applied as clearly as they should have done. So it's looking to align the interests of shareholders and participants, but going beyond a box-ticking exercise, trying not to have something where there's a whole range of different criteria, and if you tick all the boxes, you get all your awards, trying to get at something which does reflect the proper long-term economic return to shareholders. And consistently with that, there should be clear criteria for bonuses, which should be genuinely stretching. What does genuinely stretching mean? Well, that will vary from company to company. I have no doubt that shareholders will have a different view on that from management, and there's lots of scope to debate that. But the principle, again, I think is clear. And I think the point coming through is that rather than just talk about these phrases when designing plans, they need to be tested. There needs to be thought given to what will happen in practice, how plans might lead to behaviour which is not optimal for the shareholders, and really try to get more depth in the terms and the criteria that apply for the plans to being adopted. There's been an announcement of a further BEIS inquiry delivering on fair pay, and this was announced on the 23rd of March this year. And the BIS launched an inquiry into executive pay and the gender gap in the private sector. So the deadline for submissions on the gender pay gap, we'll talk about gender pay in a second, but that was the 10th of April. But with a later deadline for executive pay, which is still open, to the 8th of May. So what's the BIS inquiry looking at? Well, I think there's a couple of interesting quotes there from the chair of the select committee, and you can debate whether you agree with these or not, but again, I think they're indicative of current thinking and current concerns. So the statement on the left is one which has been made in different forms many different times. Unjustified executive pay awards are the most corrosive influence on public trust in business. And there are an awful lot of questions in that. What is meant by unjustified? What is meant by executive? Where does executive begin and end? Is it correct that it's a most corrosive influence on public trust in business. You could spend all day debating those points. And linked in with that was a reference back to the Labour governments from 50 years ago, and the comment that nearly 50 years on from Barbara Castle's Equal Pay Act, it is completely unacceptable that women are not fully rewarded for the jobs that they do, which we would, I hope, all agree with in principle, but does lead to some wider questions.
Yep, so I'm going to talk about the BIS inquiry a little here. At this stage, in some ways, there's not a lot to talk about. It's still very much at the inquiry stage, but don't say I ever let that stop me. So the executive pay part of the report I'm going to deal with first. This is following up on the 2017 report on corporate governance last autumn. And I think it's probably safe to say what this is being prompted by is the fact that since that report came out, we've had a fair number of cases where high executive pay has been, how do we put this, not exactly matched by corresponding high performance. That might be a little unfair in the sense that executive pay awards that are vesting now are not going to be those made since autumn 2017. They're going to be those that were first made some years ago. But equally, it's always good to actually follow up and try and gather the evidence on what impact the latest reports by government are actually having. And executive pay is still very much an issue in the headlines. And I'll come on to talk in a little bit about some of the steps that are still coming through to try and this is very much the theme we're seeing, make pay a little bit more fair. And this is also what's coming through on the gender pay gap reporting. I don't think any of us are going to have been very surprised by the pay gaps that are being reported. For the most part, what you'll see is companies reporting average pay for men and for women, and somehow it turns out that they have a lot of male senior executives and a lot of female secretaries and cleaners. And this isn't about whether men and women are being paid the same for the same roles. It would be illegal not to pay a man and a woman doing the same job the same thing, and it has been for some time. This is more about that same issue that keeps coming up. Somehow you hire relatively equal numbers of men and women at junior levels, but somehow by the time you get to senior levels, your CEOs and CFOs, there's a preponderance of men. So there's not really much for companies to do other than to report the truth of what's happening. From a share plan lawyer perspective, the actual reporting you have to do is relatively straightforward. Averages of gender pay gap, averages of bonus pay gap, and share-based incentives where the reported pay can be a little complicated. It's taken the simplest measure of the amount subject to income tax. Query how accurate that's going to be in reporting total remuneration, but equally it's a relatively straightforward number to put in there, because there can be no doubt about what's subject to income tax, or if there is, then companies should hopefully very much already be on top of sorting that out. The deadline for reporting this was 4th of April 2018. I hope everyone listening to this, if they're subject to gender pay gap reporting, has already got their report out. But if not, you're in, I hesitate to say good company, but you're certainly in plenty of company. 1,557 companies failed to report on this by the deadline. And the takeaway here from reporting we're seeing is very much the actual reporting you might be statutorily required to give fairly straightforward. What you need to put alongside that is an explanation of how that actually translates into practice. Why do you have the gender pay gap you do, and what are you doing about it? If you have a preponderance of senior male executives, you might want to talk about what you're doing to promote female leaders coming up through the organisation. And I have to say, I also look forward to the day I read one of these reports and the company also talks about what it's doing to encourage new fathers to take paternity leave and give them flexible working as well. I hope that's not an overly cynical comment. I'll also talk a bit about some other reporting developments. The Financial Reporting Council, following up on the autumn 2017 BIS consultation we already mentioned, is going to put out an update to the UK's Corporate Governance Code this summer. This is, again, it might sound a bit of a dry issue, but it's one that's very relevant to everything we're seeing in the headlines right now. I'll come on and talk a bit about some cases of reporting in practice. The Carillion case has been very interesting from that perspective, but in particular, the Financial Reporting Council decisions on what changes there are going to be are very much far enough along that there's some interesting things to say about it. And I think it's very much in line with the general theme we're seeing, which is that it's not good enough to tick the boxes and say, okay, these are the statistics, this is what we're doing, these are the rules, here's how we're compliant with them, job done. You've got to actually intelligently apply the various guidelines you're seeing and explain how, not just how, well, this is market practice and this is what we're doing. You need to actually put some thought into your company's position and how what you're reporting applies to the very individual context of your company. In particular, an interesting development that I understand Financial Reporting Council is going to put out in the next code is to link reporting on corporate governance to reporting on corporate strategy. So it's not enough to say, yes, our governance is held to the highest standards, as all reports inevitably will. I have yet to see a company that says they're not up to the highest standards. You have to actually say how your reporting and governance requirements play into your company's plans for the future and its strategic goals. Corporate governance can be seen as a bit of a dry subject, but as I'll get on to, it is actually vital to the functioning of large companies. Similarly, another issue we've seen is this ties into some broader questions about if you ask a company director what their duties are as a director, hopefully, it's not always the case at small companies, to be honest, but certainly at larger companies, they'll be able to tell you about Section 172 of the Companies Act and their duty to their shareholders. What they won't always be quite so aware of is the sort of subsidiary duties in there. So, of course, directors have an overriding duty to act in the best interest of their shareholders, but they also need to have regard to the interest of other stakeholders. And that can be suppliers, it can be employees, and it can be creditors. So how does that translate into practice? I can see how sometimes these sort of have regard to duties can get a bit lost, because if ultimately you've got to do what's best for your shareholders, that should certainly be where your thinking first is. But these are duties which it's very hard for me to see how, if you're not thinking about the interests of your employees and your suppliers and everyone else your company works with, the wider community, environmental impact, it's very difficult for me to see how, if you're not thinking about that, you can really be fulfilling your duty to your shareholders. Because what shareholders want these days is not simply, yes, this year we're paying a nice big dividend. They're interested in the long-term financial health of the company. And if say having very poor relationships with your suppliers because you're holding back payments to them to hold back cash flow, to improve your reported cash flow, if you have poor relationships to your employees because you're underpaying them, well, it might make your company's financial position look better in the short term. But to state the obvious, if your suppliers and your employees all hate you, that's not really a good recipe for the financial health of your company in the long term. And the ICSA last autumn did put out some very interesting guidance about how to actually take stakeholder voices into account in practice. So it's not just a matter of sending out a survey to your employees, asking them to rate on a scale of 1 to 5 how well they think the directors are doing. you're going to have meaningful engagement with your employees. And you are going to have to actually explain in your reporting what steps you've taken to do that. And there's some very interesting ideas about how companies can actually do that, ranging from employee councils to appointing non-execs with responsibility for putting forward the voices of employees and indeed the wider community, and taking into account environmental stewardship, or the broader context in which companies operate. And it will be very interesting to see how that does actually impact on companies' behaviour and practice. I'm going to hand back to Stephen to talk about, I keep saying all this is important for your company in practice, and Stephen's going to talk about one case in which that's been very apparent.
Yes, thank you, Charlotte. Many people have been following this around the end of last year, over Christmas time and the new year, which relates to the LTIP plan that was put in for Persimmon. And the points flowing here don't really impact on the legal structure of the plan. As far as I'm aware, and we've not been closely involved in the actual case, there wasn't any particular controversy over the terms of the plan. The issues that came up were that there was a plan which was set up several years ago to incentivize the chief executive, the finance director, and a fairly big swathe of executives within the company at a time when the company was in some distress as a result of the market conditions at the time. And the plan did align with the strategy of the company. And the problems arose, in a sense, because the company was too successful. And what I mean by that is that the way that the plan worked through gave entitlements to the chief executive and the finance director, and a proportionately similar amount below those levels, with the CEO having an entitlement to a share of the payments on a net basis, i.e. after paying up to purchase their awards, which was in the order of £100 million. And I'll just repeat the number to be sure that people don't think they misheard. That was £100 million. And the problem that then arose was that the shareholders, being the same institutions broadly who had approved the plan, and clearly didn't think that it was going to be achieved, because they didn't then think through the consequences, which comes back to the points I was talking about earlier, decided that that was too much, it was excessive, and that it shouldn't be paid. And what we saw was a maelstrom of adverse comment made about the plan. The chairman of the Remuneration Committee resigned on the basis that he had failed to anticipate the levels of pay that could be made, and that there ought to have been a cap on total payments. Subsequently, the papers reported that the chief executive agreed to a reduction in pay in the bonus amounts of roughly 25%, if I've got the numbers right, so about £24 million. And I think that it shows a number of quite interesting points, and it comes back to what I was saying earlier about the need to think about what happens if the plan is successful. I think that shareholders ought to look at plans, and their advisors ought to look at plans and say, well, if this plan achieves all of these targets, what's going to get paid out? And if that is what's paid out, are we comfortable with that level of pay? I think that there were other implications for the plan design. The circumstances were that because of changes in legislation and the economic context of government intervention, the view was that there were windfall profits, which in essence the executives who were benefiting were able to ensure the company benefited from, but it wasn't that hard because of the opportunities which were available. There was the question of caps on payments, and the reason why the chairman of the Remuneration Committee resigned was because he was criticised for not having imposed a cap. Now, as a person who advises on plan design, I find that quite interesting, because I think that you would not, as a general rule, automatically place a cap on plan payments. And when I've discussed this with clients, the view which I have some sympathy with is that if you put a cap on the plan, why would you? Because if the shareholders are going to get extraordinary benefits, why shouldn't the executives? And given the numbers here, you might think that they got the numbers wrong. I wouldn't disagree with that. But nevertheless, the principle of having a cap at particular levels of performance is not obviously a right principle. And there's a concern that it would then encourage game playing by executives who would not wish to push the values above the cap or defer the values going above the cap until there's another reward. So I don't think it's clear that there should have been a cap. And quite possibly there were other ways it could have been, other approaches which could have been adopted to ensure that the payments didn't generate the controversy they did. Maybe, and I'm speculating, the performance conditions should have been tougher. Maybe there should have been an exclusion for windfall profits. Maybe there was a concern about distortion of corporate behaviour. We'll come on to talk about that briefly later on in the talk, but this was the plan, as I understand it, was based on returns to shareholders, and there were accelerated dividends which contributed to the plan. Maybe that was something which should have been thought about. And one thought occurs to me is that the plan, maybe, if you're looking at that sort of level of potential payout, have required phasing of payments. If you had said, well, the plan, it pays out whatever it does, but if it's in excess of, and I'm just picking a number, £10 million, the excess amount over £10 million would be paid over a more extended period. So if you got something which was running into multiple double-digit millions, that could have been paid over 10 years or more, requiring a continued focus by the recipients on the company and continued alignment with the shareholders' interests. So there's a lot that can be said about the Persimmon plan, but the point that really hit home was the degree of noise and heat, and the chief executive, whatever the background discussions were, and I don't know what the background discussions were, getting to a point where he had become entitled to receive an amount under the plan, which was then reduced substantially in response not to concerns about the legal structure of the plan, but shareholder pressure just saying, oh, that's too much, we don't like it. And I think that is an outcome as an advisor you want to avoid, and puts the emphasis on really thinking through the potential issues when first putting the plan in place. Now, looking at the other end of the spectrum, we'll come to Carillion.
Yeah, so you might be sitting here thinking, what does Carillion have to do with me? The Carillion was clearly a very badly managed company. It went bust. That's never going to happen to the company where I work. I certainly hope that's true. But nonetheless, I think there are some really interesting points that have come out of this. I actually have an article out about it, which you can read linked on our website. So I'll try not to just recap that here. Firstly, what's the relevance for everyone else here? Well, Carillion did go bust, as we all know. It went bust very rapidly. It went from being, if not a hugely successful company, to at least being a large PLC with what one normally expects to be pretty substantial backing, to going immediately into liquidation. And some of the controversy here has been that shortly before it went into liquidation, we're not talking the day before, but months rather than years and years ago, several senior executives retired or otherwise left their positions at the company and took some very large payouts with them. What were the clawback conditions? Isn't there any way that the liquidators can get that back from directors who clearly haven't been doing such a great job of promoting the company for the benefit of its shareholders, much less its creditors? Well, the Institute of Directors has strongly criticised Carillion for, in 2016, relaxing clawback conditions, so that it was no longer possible to claw back payments made to executives in the event of corporate failure. And if Carillion isn't a case of corporate failure, then I don't know what is. But what the clawback conditions you'll actually find in their plans are, since 2016, you can claw back payments to executives either in the event of gross misconduct or in the event that the results on which those payments were based are found to have been misstated. And those aren't unusual conditions. Those are very routine conditions. That's what you'll see in the plans operated by most big companies. So I doubt that the Carillion Remuneration Committee were actually thinking, yes, you know what, we think that if the company is liquidated, then executives should still be able to keep payouts. It's more likely they were just putting in what they thought of as standard terms. So while I think most companies might well take from this that actually, yes, you should have a specific condition that payments can be clawed back if the company becomes insolvent, regardless of how unlikely you think that is. Equally, I think this is a lesson both about providing, as with Persimmon, providing both what you might think are very unlikely outcomes in your plan rules, but also I think this is a lesson about performance targets. The Carillion performance targets, if you read through their accounts, which I have, you'll see a series of to what extent have these awards vested based on measures like TSR, company profitability, and it'll be a whole list of nil, 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 as you'd expect. The payouts going to executives have been based on what might be described as softer targets, so things like number of health and safety incidents. And I'm not going to go from here to bash health and safety. When you're talking about a company, a construction company, then health and safety is how many serious injuries, for example, your employees have had. And I think we can all agree that is actually a very important measure. But being a little bit cynical, I might suggest that if you have internal measures like that, it's a bit easier to play around with them and make sure that you're hitting your performance targets than it is with measures based on your audited accounts. So it's really, there's a bit of tension here between, I've mentioned that companies are being asked to move away from plans based solely on measures like TSR and focus on return to shareholders, and look a bit more broadly at how they're serving their other stakeholders and the broader community in which they operate. But equally, that's always a little bit harder to measure than purely financial targets. And that's an ongoing challenge for companies. And I'll be interested to see how that actually translates into the sort of performance targets we're seeing in plans over the next few years. Secondly, this is also a strong illustration of the importance of directors considering their duties other than to shareholders. While I think that Carillion's shareholders, as were, are probably pretty unhappy right now, so it's safe to say that that primary duty might not have been foremost in the minds of the Carillion directors, then actually the people who are being seen to have really lost out from Carillion aren't shareholders. If you're investing in shares, then you know that the value of shares can go down as well as up in that classic statement. But if you're a supplier and you're expecting to get paid by the company you're a contractor for, you don't get paid for months and months, and then that company suddenly goes insolvent, then as we're seeing, this is having a real impact. There are other companies going insolvent, or at least being in serious financial circumstances as a result of the Carillion crisis. There are employees losing their jobs. And these aren't people who were investors in a position to decide what sort of risk they were taking. These are people who are expecting to get paid for their work every day. Finally, I'm also going to talk a little bit about Carillion's overall reporting. I say I've read their accounts, but you don't get the impression from their accounts over the last few years that this is a company on the brink of crisis with serious deficiencies in its reporting. The reports say front and centre that their high standards of corporate governance, etc., the usual cliched phrases, are central to their business. What's happening there? How can they still be saying that in their accounts when their company is clearly a basket case? If you read through the select committee transcripts where they're interviewing the various directors, and in particular their former REMCO chairman, or chairwoman in that case, you will see a lot of commitment to matching market practice, a commitment to following normal standards, and effectively, I have to say, if you're trying to work out what's gone wrong, it does sound like a bit of the exact sort of tick box mindset that recent reports have been criticising. We've certainly had, I mean, I know that we at Pett Franklin have had discussions with clients where they ask us what sort of awards should we put in place. We have a discussion about what might be best for their company. And sometimes what might be best for their company is something that's slightly unusual. And there tends to be a lot of discomfort with that. How can we explain to our shareholders that we're doing something that isn't the same as what every other company is doing? Well, if you look at the Investment Association guidance, then they're suggesting exactly that. Stop just thoughtlessly doing what you think is the normal practice and start thinking about how your company, what your targets are and what sort of remuneration structure really would encourage your executives to achieve that. So there's a bit of tension there. And I think it's safe to say there are legitimate frustrations on both sides. If you talk to executives, they'll say, well, of course, the guidance says that, but in practice, our shareholders really hate it if we do anything that's not, very conventional standard practice. And then you'll talk to shareholders and they'll say, well, if you want to do something different, please actually explain it to us. And so I think there are probably lessons to be learned on both sides. And as always, I know this is what keeps coming up again and again in these consultations and reports, but it's important that executives and the Remuneration Committee to actually start talking to shareholders about what they want from remuneration in advance and engaging with their major shareholders and, really legitimately consulting on what they think the structure should be. And that's similarly what we're seeing some of these developments about, for example, reporting of executive pay and a public register of companies where they've had significant shareholder dissent on their resolutions are trying to achieve. So I'm also going to briefly skim over some less strategic other developments. None of these are things that I'm going to talk about at length, but it's worth noting that there's also been some research recently on company share buybacks. The EIS are concerned that those could be used to artificially inflate executive pay. And I think that's a legitimate concern. While obviously there are plenty of good reasons companies might carry out a share buyback, equally, if companies have performance targets in their remuneration plans, which have TSR as a key measure, one way to increase your TSR, total shareholder return, is rather than, for example, working to boost your company profits, you could just try and reduce the number of shares in issue, which will nicely increase that metric without necessarily increasing the overall profitability or, really working to actually benefit the shareholders and the company. So it'll be interesting to see what comes out of that. Secondly, this may not be very relevant to most of the people listening, but as I'm certainly very aware, enterprise management incentive share options, they're for smaller companies, so up to 250 employees or up to 30 million gross assets. And this is a tax advantage share option plan designed to try and allow smaller companies to compete with much bigger companies for talented key employees. A small company might not be able to offer the same headline salary, but they can offer share options on a very tax advantaged basis, so that if that small company does down the line become very successful, those employees will be able to will be remunerated in the form of a share in that success. Because that's a targeted plan, it needs EU state aid approval. It's within the scope of EU state aid rules. It needs EU approval to continue. That hasn't been controversial to date. There's been a couple of plans recently put in place by, for example, Sweden and I think Ireland, which are fairly similar to EMI. But for whatever reason, renewal of state aid approval wasn't actually obtained for EMI by the deadline on 6th of April 2018. So for companies that haven't granted EMI share options before the end of last week, it's a problem. Is EMI going to be approved? We hope so. That's certainly what the noises we're hearing say. But when that will happen, whether it will be subject to any different conditions, we just don't know. And it's worth noting that the announcement that renewal of approval wouldn't be received before the deadline expired came out on midday on the 4th of April. So that made for a very interesting couple of days for those of us with EMI clients who were trying to get over the deadline before then. I'm also just going to mention a development that came out recently. The government's looking to extend the period for ShareSave contributions holidays. So if you operate a ShareSave plan, the period over which employees can pause contributions from 6 months to 12 months. And the idea is to align that with the period over which a lot of employees can take parental leave. That will often be 1 year rather than 6 months these days. But it's not only for employees taking parental leave, it's for any employee, as obviously there can be a number of reasons why someone might need to take a pause from contributions for a time. That delay to the implementation has been so that administrators and so on can make sure they've got the systems in place to deal with that. This shouldn't be a controversial change, but one comment that William Franklin at our firm, who unlike me is a qualified accountant, made on hearing of this is this going to increase the accounting costs for companies of making ShareSave awards, because now those costs are going to be calculated on the assumption that options could be in play for up to 12 months longer than they might otherwise have been. Don't know what the impact of that will be yet, but for those of us preparing share plans, it's speaking as a lawyer, I know that it's sometimes difficult to remember to take into account the accounting consequences of share plans. I'm lucky to work with an accountant who will make sure I do. That's William. But it's always worth bearing in mind that even if those consequences don't appear immediately on your balance sheet, they're still important to think about. Final point, as we should all know, the filing deadline for your employment-related securities online return, so that's for return everyone who operates any sort of share plan has to file, is coming up. Please don't leave it till just before the deadline to complete this. As we're all probably aware by now, it can be a deceptively tricky return to complete and file. Assuming that HMRC's systems are working this year, let's all cross our fingers, then it can still be quite a tricky form to interpret. It doesn't have lots of flexibility, and HMRC's systems do assume that you won't make any mistakes while completing it. So if you, for example, incorrectly register your CSOP as a ShareSave, as can happen, if you've done that, you're not the only one, then unfortunately it can be quite tricky to correct your mistakes. So if you need any help with that, I won't seek to go through completing the return in detail right now, but please do feel free to get in touch.
Okay, thank you, Charlotte. I'll just quickly sum up, really. I think that as we've seen in many different angles and aspects of reward structures and plans, there have been lots of change. The case law demonstrates the need both to prepare and interpret plans carefully, and not only to do that with careful legal analysis, but also in the context of wider contractual and employment law considerations. The combination of the case law and the wider developments emphasises the need for careful, commercially relevant plan design and documentation. And that's not something which is about ticking boxes, it's about getting the legal structure and the tax structure to fit with the wider objectives, the wider context, and the wider commercial operation of the companies concerned. So at that point, I will thank everybody for listening. If you have questions, please feel free to email them to either myself or Charlotte. I've got the details for both of us on the screen in front of you now, and it'll be on the slides which will be available shortly after this webinar. So I will just thank everybody and hope you have a good rest of the day. Thank you very much.